Hi guys, it's Marissa here from Rise High, and I'm joined by the lovely Amanda Watchman from RittWatchman and Associates. Amanda is a very experienced accountant, and she has been working with a lot of our clients, particularly after our senior accountant from Rise High Accounting moved interstate. Amanda came to the rescue and has been helping lots of those clients, lots of our clients with their accounting needs. And I was really glad that Amanda decided to join us today, because I wanted to go through some of the tax and finance implications, particularly around a lot of the government relief packages that we've seen with the coronavirus. And Amanda's kindly offered to help us out with these questions today. And this is her first Facebook Live, so
bear with me.
So very exciting. But today we're hoping to answer all of your questions, and we're hoping to go through three different types of customer scenarios. Firstly, we're going to start with business owners, then we're going to move into property investors, then we're going to move into individuals. So hopefully with what we cover today, your questions will be answered. Now, of course, as always, we will be taking questions as we're going through the segment. So you can post your questions below in the comments section, and we'll be happy to answer those. And we'd love to hear your comments and feedback as we go through. So please feel free to get in touch. So Amanda, how are you going?
We're all going well. It's been a little bit of a getting used to the whole situation for the team at RittWatchman, as well as clients that are being affected by the coronavirus and what's going on with their situation. So it's a lot of balancing really, and just trying to get sorted with what's going on and moving forward and having plans.
And I think we were chatting just before, and I think what's interesting is that, there are some businesses and some people that are struggling, but like you said to me earlier, that there's also some businesses that are actually still performing really well. What's your experience in terms of what are you seeing out there?
It's interesting. The business building industry is still doing so well as far as what's going on with them. There's obviously restrictions on what they can do, but they're still able to perform and get their work done. There has been a decrease, but it hasn't been so bad. Obviously, transport is doing really well, and IGAs and food supermarkets and all that are doing well as well. So there are some that are doing really well, and obviously some like hairdressers and barbers and all that have been really impacted by the restrictions and not being able to actually be open. So it's been a variety of different situations.
Well, hopefully, given that we are doing quite well to contain the virus, hopefully we'll see those businesses be able to open up again soon, because it is quite difficult for those that have had to close. So let's move into government relief for businesses. Maybe we start at the federal level first. One that's probably, top of mind is, there's quite a few different relief packages for businesses. Probably the big one is the JobKeeper, but we might come back to that one, and we might just start with the withholding benefit that's being
the one that's actually coming through now, which is quite good. So that's the PAYG cash flow boost. And that's basically relating to people that are paying employees. When you lodge your BAS in the March quarter, you can get a minimum of 10,000 to 100,000, and it's looking to basically bring those boosts up until September 2020. So we've lodged a few BASs as it is, and I've noticed a lot of businesses that have less PAYG withholding employees are getting the 10,000 straight up. And that's going onto their tax or BAS debt, and then the remainder is getting refunded back to them. So
just to clarify, so this is only eligible for employers.
Yes.
So they have to have staff to be eligible for this. So it's business owners with staff, and so they go ahead and they lodge their quarterly BAS report, which would then normally in a normal quarter they would then have to pay their GST and their withholding tax. For their staff in that period. So what you're saying is that, what happens now? So they lodge, and now let's say that their withholding is more than 10,000. What's actually happening?
So originally what the ATO pretty much specified was, with your W2 figure, it was going to be times by 3. So whatever you withheld at W2, which is your PAYG withholding for wages, was what the ATO was going to times by 3, and then give you a credit in your integrated client account on the ATO portal. What's happening, it seems, if you are less than the 10,000 in PAYG, you're just getting the 10,000. But if you're more, you're getting up to 50,000. So it's
so you're getting whatever your withholding is.
Yeah.
And when you say times by 3, that's for the month of January, February, March.
Yeah.
Yep.
Yeah.
And what about the GST component of the BAS statement?
Yeah. So the GST is not really being considered at all at the moment. So if you're getting your $10,000 in your refund, I guess, as your cash flow injection, then that money is also being offset against any GST credits that you have attached.
So is that only if your withholding is less than 10,000?
Yeah.
So if your withholding is 15,000, for example,
you'd more than likely get
you still have to pay the GST component?
No, you're more than likely going to get the higher PAYG withholding cash flow injection. So at the moment, I've had a couple of clients that had I had one that had 23,000 in PAYG withheld W2, and they received 50,000.
Right.
So they are.
What people are receiving is not necessarily in line with their withholding.
Yeah. It seems to be more.
So how do people know what they're going to receive?
This is the question. Yeah, it is. I originally thought it was going to be times 3, but it wasn't.
Yeah.
It pretty much seems to be a lump sum amount.
Okay.
So they are eligible to receive up to 20,000 minimum.
So you just have to lodge a BAS statement and see what happens.
Yeah, exactly. That's what I'm saying.
Okay.
Yeah.
Interesting. So look, we might do a few shout outs because there's a few people that have tuned in live, which is great. Hi Emily, hi Sineth, hi Chris, Tanya, Julian and Andrew, thank you so much for tuning in, guys. Like we said, if you've got any questions or comments, please put them through. Amanda is the expert and we've got her here to answer all of our questions. So we've just spoken about the PAYG withholding, and I think we've explained that. I mean, there's obviously still a few unknowns, but I guess things are evolving and moving so quickly with all of these government relief packages that it's just a changing
environment.
It's a changing environment, so it's really important to have an expert like Amanda or like your local accountant that is going to be able to help guide you through, because things are changing almost daily. Is that correct?
Exactly. I think the point to note really is get your BAS in, and then you'll find out what you're going to be eligible to receive, because any cash flow injection right now, any boost will help anyone who's needing the cash, really.
Absolutely.
And I think that's what they want.
Yeah, absolutely. So you're not actually getting the cash, you're just getting a credit on your ATO portal. But I mean, you don't have to pay the money.
You don't have to pay the money, but a lot of the clients that if the cash flow boost has been less than what their overall GST amount was, they're actually getting that refund back into their bank account.
Oh wow!
So you are getting the money at the end. So it's basically it's a good idea.
That can be very helpful, especially for businesses that aren't operating, that really need that cash flow right now.
Exactly.
So the bottom line is get your BAS in
Get
ASAP.
the BAS in, absolutely. Yes.
I think we've covered that. Can we move on to JobKeeper?
Yeah.
How do you feel about that?
Yes, so JobKeeper's a whole new ball game as well.
Yeah,
which is very
it's a big one as well. It's obviously, we've been having heaps of questions about this, and there still seems to be so many unknowns and so much change happening. But let's just start with, firstly, who's eligible for JobKeeper, and then move on to sort of how they would apply, and then let's talk about some of the intricacies around it.
Yeah, so with the JobKeeper scheme, it's basically anyone that is employing people. So it's if you had an ABN from the 12th of March, if you're employing people from the 1st of March, if you're obviously your turnover is less than 50 million, which is the majority of the people, small to medium-sized businesses. And that you obviously you believe that you're going to your gross turnover has reduced by up to 30% in the months that have led to the coronavirus. So it's starting from March, April up to September, and at this stage it's really hard. The ATO is requiring you to estimate if you think that there's going to be a decline in sales, and knowing that is quite difficult. At the moment, we have, I'm suggesting to clients, get your accounts up to date, make sure your reconciliations are up to date, and do the comparison for March, do the comparison for April, because obviously we're at the end of April, and then have a look to see where you're going and how you're tracking for May and June. So for me, I would say look at your calendar, look at the number of meetings that are going through your business, look at the number of appointments that you have, Is there any kind of sale bookings that you're going to attend to clients' addresses and premises to do work for? To give you an idea of how you're going to be tracking as far as May and June, because we don't know what's going on there.
Yeah, and I think you've hit the nail on the head. Like the main challenge with the JobKeeper and whether to apply is knowing if you've passed the test, knowing if you're eligible, and also predicting accurately. I mean, you would even argue that businesses that are currently closed can't necessarily predict accurately, because it's possible in a month or 2 months that they might be able to reopen,
we don't
and
know.
Demand will be really strong. So it's really hard to know what's going to happen. So for business owners out there that are really struggling with knowing whether they qualify and whether they should apply, what do you recommend? Do you recommend they speak to their accountant, or are you doing those sort of calculations for your clients? Like, where do they go if they're just not sure about what they should do?
Well, at this point in time, we've got there's a lot of help and tips and everything on the internet, and I've given a couple of links to Marissa to provide on the link. But I pretty much suggest at this point in time, look at how your business is tracking. Do a comparison for your March to March, so March 2020 compared to March 2019, and see how your gross turnover has gone in those 2 months, to see if they've actually reduced or declined. And also in April as well, because we're almost at the end of April, and you'll be able to see how you've actually performed as far as what it was like this time last year to now. If you do believe that you are going to go down, then I suggest either speak to your accountant or give us a call. It's a 5-minute kind of exercise that we do on the ATO portal, and it just means you're enrolled. The first thing you've got to do is enroll. The ATO doesn't want any information yet until the 4th of May. So get yourself enrolled. That's you can't apply until the 4th of May. No, you can enroll. You're enrolled. Everyone can enroll now.
Oh, you can enroll now.
But no information can be provided to the ATO until May, 4th of May.
Right. Okay. So what's the enrolment process involved?
So the enrolment process is basically, has my business experienced a 30% loss in gross turnover, and what months has that happened? Do I employ employees? And
so it's just like a few questions
that you just
have to answer.
Yeah.
So it's quite an easy process to enrol.
Yeah.
Okay.
And once you're enrolled, the ATO have all your information online, and then they will obviously get into contact with you or the contact person that you put on the form to get the ball rolling when they're ready to get the information from
Okay. So what happens if your forecasts are wrong? So let's say you can qualify for the month of April, for example, that you can show that you've had that 30% reduction in April, but then let's say miraculously, May, June, July ends up being quite positive and quite strong. What happens at that point? Like, do you come out of the program, or do you have to pay the money back? Like, what's...
Yeah, it's at this point in time, it's really hard to kind of say with definitively like what they actually are expecting us to do. They want us to report on the basis that we have in the past, which is on a quarterly basis. Although they're asking for the month by month idea of how you're progressing, they will look at the quarter of how you've actually traded. So if you've traded for the quarter, April, May and June, less than April, May and June last year, then you have tracked to do that. You've been eligible and your criteria has been met. The problem that we have obviously is we don't know how the criteria has been met and if it's been met. So it's a matter of obviously keeping our reports up to date as we progress. So May, keep your reports up to date. In June, keep your reports up to date so we know where we're going. And if you do believe that you have increased the sales and you are doing better, then notify the ATO straight away.
Yeah, and then at that point, what's likely to happen? I guess we probably don't know. There's a few unknowns about that, but probably keeping close to your accountant and making sure that you're publishing accurate data to the ATO is probably the first.
Yeah, exactly.
First point.
Yeah.
Okay.
What they are saying, I'll just make a note, what they are saying is if you have done it wrong and if your income has not met the criteria standards, you will have to repay the JobKeeper with interest. So it's a matter of just being basically continuous in the reporting.
And that's quite quite scary, really, to think that you might have to pay it back, especially if you're in a position where you're employing people that are actually earning less than $1,500 a fortnight, which means you're actually paying them the $1,500 a fortnight, and then you might end up having to pay that money back to the government, but you probably can't get it off of them. So it might not only be a refund of what you've actually received, it might be more than what you've managed to keep in your business.
Yeah,
so
and unfortunately, it's basically the HO.
It's pretty important to get an accountant to probably check it off.
Keep it up to date
to make sure that you've actually assessed the eligibility correctly.
Absolutely.
Would you say?
Yeah, absolutely.
Yeah,
and
make
just
sure you get
be
good
proactive. Don't hold off and don't basically delay letting the ATO know if you believe it's increased. I would tell them straight away.
Yeah, awesome.
Yeah.
And I think we touched on the fact that it's for employers, but it's also for sole traders as well. Can you explain how that works?
Yeah, so basically they realised after the announcement that their sole traders, trusts of trustees, also companies, so directors of companies, they all weren't included in this scheme. So they've since revisited that, and they've incorporated basically any sole trader, one trust of a trustee that receives beneficiaries are allowed to be entitled to it, as well as a director that isn't getting wages. They're also entitled to be eligible to receive the JobKeeper as well. So
if you've got a husband and wife business and neither of them are employees, they're both, directors or, trustees or something like that, the JobKeeper is only available for one of those people, so the other one will miss out.
Yes.
Maybe the other one could get JobSeeker.
Yes,
Would
that's what they're looking at.
Possibility. Yeah. So in terms of, let's say a business is eligible and they are receiving the JobKeeper payments, and they're also receiving the quarterly PAYG, rebates or credits, whatever we want to call them. How do they get taxed? How do they get treated from a tax perspective for the business? Do they just get added to the revenue of the business and then get taxed at the tax rate?
Yeah.
What's the go there?
So at the moment, basically if you use an accounting program, so a software program like Xero or MyOb, they've also provided some guidance on how to account for that in those programs. But basically, the suggestion is to add a new chart of account, so an income account called JobKeeper Cash Injection. So that you are still able to declare that as income with no GST, but it's not going to affect the gross turnover that you're going to be required to provide to the ATO when you're looking at the gross margins of what's going on.
So will that actually increase your profit, your net profit?
It
that
will
then have to be either distributed if you run your business through a trust, or that you'll have to pay tax on if you run your business through a company.
So it is going to be taxable.
So just get added, And for employees that receive the $1,500 JobKeeper payment. Let's say previously their wage wasn't $1,500. What will happen to their tax?
So they're going to be taxed. So the JobKeeper is basically taxed to the employee as a wage, basically. So they will be declaring the wage in through their PAYG group certificate when they lodge their tax returns. So they will receive more if they have previously received less for the week, but it will be taxable for them.
Yeah. Okay, great. A few shout outs before we move on to the next topic. So Sarah, Luke, Tem, Penny, Damien, Nikki, Delia, thanks for tuning in, guys. Really appreciate having you with us today. Once again, if we have any questions, any comments, please put them in the comment section below. We're here to answer your questions today. So we're still on the topic of small business owners, and one thing that we haven't touched on is the payroll tax, because there's also some relief there as well. Can you just explain that to us?
Yeah, so Revenue SA have come on board, and they're basically have allowed businesses that pay payroll tax, which is up to $4 million in gross Australian group wages, for $4 million or less, they will be able to defer their payroll tax liabilities for the 6-month period. They don't have to apply, nothing's actually required for anyone to do. The Revenue SA will automatically put them on that list, and they'll be notified through their online registration process.
So that's also, so the people that are receiving the payroll tax relief, they don't have to do anything.
They don't have to do anything.
And also the going back to the withholding PAYG relief, they don't have to do anything either. They just have to lodge their BAS. So the only one that requires action is the JobKeeper. Is that correct?
Yeah, that's correct.
Yeah, and that requires action to register and
Yeah.
Okay, so that does that pretty much cover the federal federal government relief for small business? So let's move on to state government relief for small business, and we're going to mainly focus on SA, South Australia. I know that we've got a few viewers that are from interstate, so you have to check the different states, and we can get you some details on that if you want those details. But for SA, the state government has announced a $10,000 cash grant. Let's just talk about that briefly, just to explain what that is and how people can access that.
Yeah, so that's a really good grant that the SA government have provided. There are a few eligibility restrictions, which basically you have to have received the JobKeeper, you have to have employed people, you have to have been in business and have an ABN. And you also have to have been significantly impacted by the restrictions of the COVID-19 restrictions that have been in play in the state. So you have to obviously achieve all those criteria and categories to be able to be eligible for the grant.
So just to clarify that, if there is a business that is eligible for JobKeeper but they're still operating in their normal capacity, they wouldn't qualify for the $10,000?
No, well, they may or may not. It seems that you have to be in dire straits, basically,
to get that money.
To get the grant.
And it's interesting to note that you're not eligible to get it until you're getting JobKeeper. So realistically, no one's going to get this 10K until the end of May.
Yeah, well,
would that be around?
Basically, and you've actually only got until applications are open now, but you've only got up until the 1st of June to apply for this grant. So, and you don't really know.
So that's really interesting, because you don't even know by then if you're eligible for the JobKeeper.
Well, ideally the ATO are going to start giving us the criteria.
Sorry, a little technical difficulty.
I'm obviously moving my hand too much.
We'll just leave.
But I think what the biggest thing is they're wanting to give you the grant, but you don't really know if you're going to be receiving the JobKeeper. So ideally, when we start giving the information to the ATO through the JobKeeper portal, we're going to know if you are eligible, if you are meeting those standards, and then you can obviously apply for the grant. So we'll have some time, hopefully a month, where we'll know who's going to be eligible for it. So
it's probably worth people applying if they think they're going to be eligible. So that they don't miss out.
Yes.
Would you say that would be a fair comment?
And obviously the state knows that the grant the JobKeeper hasn't been actually processed as yet. So those questions, yes, you have to say no for, but they will allow you to come back and provide that evidence once you've got your acceptance from the ATO.
Because I've heard that the JobKeeper applications, they're not actually going to come back and tell you that your application's been approved. They're just going to start paying the $1,500 per fortnight. And when I looked at the state government's relief package, the criteria, it did say that you have to provide evidence that you have been approved for JobKeeper or that you're receiving payments. So
you're going to have to really see.
It's a little bit delayed.
It is delayed, and it's not really communicating between the two, which it is unfortunately how it's going to happen. But I believe when you upload that information on the portal, you will they have got the ticks and checks on the portal, which you'll be able to screen print to say that you are eligible or not. But I guess once you start receiving the JobKeeper, you'll have the bank transactions to be able to prove to the grant as well. So.
Excellent. Well, we've had a question come through from Sharon. The question is, would JobKeeper be applicable if income from rental properties has been reduced? Has one through family trust and one in joint names. So, Sharon, can you just let us know if the entity is a trading entity, or is it just actually owning properties? Because my understanding is that JobKeeper is only available for trading entities, so businesses that are operating. So where you've got a company or a trust that just owns residential or commercial investment properties, would they be able to apply for JobKeeper?
Well, see, there's been no kind of specification on that as far as if they are. They are, at the end of the day, you can apply as being a trustee for the trust. So if you are a beneficiary of a trust, then you can still apply. But rental properties are seen more so as property investors, not so much business trading trading structures. So I don't believe as a rental property owner in a trust structure you would be eligible for the JobKeeper.
Yeah, that's a really interesting one, because I haven't heard much information about that. And there's a lot of investors that do own their properties through trusts and companies. And if they have had a period that, where the
had no
rental income has reduced, or they've ceased getting rental income because their tenants stopped paying. I wonder if they would be eligible for JobKeeper.
Yeah, I definitely, I can have a look definitely and research that a little bit more. But I believe that my understanding is if you have a rental property, then your insurance should hopefully kick in to give you some sort of benefit as well, so that cash flow is not actually being restricted for you. You may be able to actually apply or get that kind of assistance through your insurance. Because there's been no mention of rental properties. I don't think the ATO is really focusing on trust as rental real estate owners, just because of the fact that they're trying to keep the JobKeeper for people that have lost
more
income.
Trading entities. Is that something that I can ask you to just take offline, and maybe we can provide some more?
Absolutely.
So maybe we'll come back in the comments following today's segment to give an update on whether JobKeeper would apply for non-trading entities. So at this stage we're thinking probably not, but we'll just confirm and come back to you on that.
Yeah, that sounds good.
So before we move on to investors and individuals, can we just sort of summarise if you've got any other tax tips or finance tips for business owners?
Well,
obviously June 30 is not far away.
No,
we're now nearly at the end of April. So, what are some other general tips that you think people should be aware of leading up to end of tax time?
Yeah, absolutely. So I think just as a summary, basically, I'm saying enroll in anything that you can get your enrolment in. So enroll for your JobKeeper, enroll for your grant, see what happens. If you're not enrolled, you won't know. So my priority would be to enroll and get your business in there at least. Keep everything up to date as far as your books is concerned. Make sure all the accounts are current. So when you're looking at your data, it's actually providing real live situations of what's happening in your business and your profitability. And looking forward, obviously June's coming up, so maybe do some tax planning, looking to vary your PAYG instalments if your tax is going to be, taxable income is reduced for your business or for yourself personally, and maybe look to vary them in your BAS or IASs for March and June, so you're more reflecting what's actually going on in the current situation.
Yeah, awesome. They are really, really good tips. Huge welcome to Marissa, Amanda, Anita. Thanks for joining us, guys. Glad to have you on board. And feel free to ask any questions in the comment section below. So we might actually move on to property investors.
Yes,
if that's okay. So we do have a lot of property investors in our community at Rise High. So they're obviously keen to understand what's going to happen for them. And I think the biggest topic at the moment for property investors is tenants that are asking for reduced rent or maybe not paying their rent. How does that impact, what are the tax implications of that for them? Can we just talk about that for a little bit?
I mean, I guess if we go back to the tax rulings and what the legislation's all about with rental properties, basically you will declare the income once you've received it. So if you physically receive your rental income, then that's when you declare the income. If you don't receive the income, then you can't declare the income. So I guess in the lines of when you're preparing your tax return for 2020, it's when you actually physically receive that rent. So if you're receiving a decline in rent, then obviously that's going to reduce your rental income.
And how does it work? Because many investors who are in that position are potentially putting their home loan repayments on hold for their investment loans. So that obviously means that during that period they're not making any home loan repayments on that investment loan, but the interest is still capitalising. So what happens in terms of the interest expense during that period? Is the interest still being expensed during that period even though they're not actually physically making repayments, or is the interest going to be expensed at the end of that home loan repayment? How does that all work?
It's a really good question, because it's going to be interesting to see how banks actually disclose that in their year end. You know how you have your year-to-date interest paid for the year. If they're going to separate that disclosure.
So it might be different for each bank.
I think so, because basically you can only claim interest when it's physically paid. So if you're delaying or deferring your home loan repayments, and then you are also capitalising the interest, which goes against the actual capital of the loan value at the end, and is pushed further, then you're not necessarily paying the interest, so you can't really claim the deduction. So it'll be interesting to see if the banks kind of provide a summary of what's been capitalised and what's actually been physically paid.
And do you know what? I think they're all going to be a bit different.
I think
so I think if you are applying for a home loan repayment deferral, you really need to understand what that means for you, for your bank, because we've seen that, some banks are going to capitalise onto the loan, which means they're just going to increase the loan amount by that amount, and then that's going to be paid off over the remaining term. Other banks are actually going to come knocking on your door at the end of the 3 or 6 month period wanting you to pay that full lump sum of interest at that time. So it's really different for each bank as to what is actually going to be allowed with that capitalised interest. So I think if you are wanting to have that loan the loan repayment deferral, then you need to make sure that you understand what that means from your perspective.
Absolutely, yeah. And even if you are deferring your home loan repayments, even if you speak to your bank to say, I want to pay my interest so I can get the tax deduction, that might be another way of getting around being able to claim it for this current financial year.
Yeah.
It really depends what the banks are deciding to do at that point. It's a lot of unknowns, unfortunately. So it's better just communicating and being upfront and just trying to understand what your banks are going to provide to you.
Absolutely. And are there any other tax tips that you've got for property investors that you think are important?
Yeah, I mean, obviously with not receiving rent, or if you're getting deferrals, or if you're one of those tenants that have actually allowed, one of the landlords have allowed the tenants to cease paying rent for a period of time. Obviously keeping everything recorded and properly recorded, so we document it. So if you have received, if you're reporting a significant decline in rental income for the year, we have the evidence to say these are the reasons why. And I gave them 3 months in lieu, or 3 months rent free, just to allow them to not get into more financial hardship. So it's just a matter of communicating.
And what happens in the case, let's just look at worst case scenario. So let's say that you do lose your tenant and that you do find it really hard to find a new tenant over a 6 month period, which you'd hope that you would find a tenant, but let's just look at worst case scenarios. So the property is vacant for a long period of time. Does that impact your ability to be able to claim the interest on that loan?
No, I mean, to be able to claim a tax deduction for your rental property, it has to be available for rent. So as long as it's available for rent for that whole period of time, you can claim anything relating to the holding of that property, even including interest, rates of taxes, provided that it's available for rent. The one thing that I would say is obviously speak to insurance companies. If you're not getting rent, or if your tenant has left, due to some factors regarding the COVID virus, there might be some policies that are in play that help you get some rent relief, I guess, or rent assistance through your insurance provider.
It's so important to speak to the insurance provider, because I know that they all have really different views on how they're going to look at this and how they're going to support investors through this period as well. And there are definitely certain steps that they require you to take for your insurance to kick in. So it's really important that if you are a property investor and you have a period of reduced rent, or rent deferral, or vacancy, or no rent at all, that you are speaking to your insurance provider, that you are making sure that you understand what your home loan repayment deferral actually means for you, and when you're actually going to have to pay that interest, and that you're speaking to your accountant so that you can tie it all together to ensure that you understand your tax implications and understand how it's going to impact your cash flow. I think all of those things are so important.
Are all very relevant and need to be addressed.
And once again, as important it is for business owners to keep really accurate records, it's so important for property investors.
Absolutely.
Now more than ever, I think.
Now more than ever, for sure. Yeah, and have everything documented, have the evidence, because that's the way that we can substantiate why we're claiming deductions or why we're claiming income. So the more the better, I find.
Excellent. Before we move on to individuals, I will ask you to just see if there's any other tax tips you have for property investors. But before we do that, I'll shout out to Richard, Priya and Zach. Thanks for joining us, guys. So we are about to move on to individuals, but before we do you reckon we've covered everything for property investors? I think
property investors, main thing is obviously look at your insurance, look at your bank, and keep everything documented.
Excellent. And we will come back to you about whether property owning entities that are just non-trading entities can apply for JobKeeper. So we'll put that question on notice and come back to you on that one. So let's move on to individuals. So there's really two types of individuals that have been affected by coronavirus, and one is an individual that's completely lost their job. Another is an individual that hasn't lost their job but has had reduced hours and hence reduced income. So let's talk about the individual that's completely lost their job, and I guess they even fall into two categories, one that potentially can apply for job seeker and one that might receive JobKeeper. So let's drill down into each of those and just understand what that actually means, what it means from a tax perspective, and just sort of dwell into that a little bit further.
Okay, so with the job seeker, I mean, that was the first thing that was actually introduced when this all started way back a month ago, and you saw the lines in Centrelink. So anyone that lost their job straight away or were made redundant due to closures of cafes and restaurants, they were obviously going to Centrelink to receive or apply for job seeker. And job seeker is similar to youth allowance, so it is tax deductible, taxable income. As far as the ATO is concerned, you will have to declare the income in your tax return. But because it is a government-based allowance or payment, they will be taxing you according to the rules of withholding tax.
So people won't actually receive the $1,100 in their bank account; they'll receive the $1,100 minus the tax.
If applicable, for sure. So ideally, enough tax will be put away for their situation of how much they're receiving. So they don't have a whopping great tax bill at the end either.
So what about in the case of someone that was on quite a high income previously, and now they've gone down to the $1,100 per fortnight? That potentially might mean that they've overpaid their tax. For the financial year. Is there any way that they can actually get some of that back if they need the cash?
No, unfortunately not. It'll be when you actually lodge your tax return. So any additional or greater PAYG withholding that you had through your wages, that will obviously be received once you lodge your tax return. So it may be an idea to look to lodge your tax return earlier.
As soon as possible.
Yeah, July, August, And
really that's not far away. So the sooner you can lodge your tax return, the quicker you're going to get that refund. I imagine there's going to be a lot of people lodging their tax returns pretty early this year.
Well, it happened last year as well with the 1,080 that was announced. People wanted to get their tax returns done quite quickly to get the tax offset. But it is a good idea to look to do your tax return if you think that your situation has changed and you may be getting some additional cash assistance, I guess, when you get your tax return lodged. For sure.
So for those employees who have lost their job or been stood down and they're receiving the JobKeeper payments, what do they need to be aware of from a tax perspective?
Well, basically just making sure that they're putting enough tax away when they're receiving the income.
So is their employer holding back the tax from that payment first?
With the JobKeeper, yeah, absolutely.
So does the employee or the individual have to hold back anything for tax as well? Or?
No, not unless they want to elect to. So basically they will be getting their wage as normal. They can elect to put more money into super if they wanted to with that additional, if they're getting less. So some employees were only getting, let's say, $500 and they're going to be eligible to receive $750, they can elect to put some of that money into super if they wanted to, or put additional amounts into tax if they wanted to. So
I guess that raises a good point, because whilst you're on job seeker, you're obviously not receiving any superannuation. So that's obviously something to think about. When you're on JobKeeper, my understanding is that it's optional for the employer whether they're going to pay superannuation for that employee. So you may once again have a period of time where there's no money going into your super. So particularly if you're getting close to retirement, this could be a bit of a problem, because superannuation balances have really dropped.
So with that, it's probably good to know that if your normal wage is $500, that super would be put against that $500, but it's the difference. So it's a difference to make up to that $750 that employees don't necessarily have to put super away for. So it's just the difference, not the whole amount.
So you might still be getting a little bit of super, but not the full amount that you would normally get. So that's just something to be aware of, I think, and just to keep in mind. We've had a question come through from Tanya. Can you clarify if job seeker income is tested for households, e.g. husband still working?
Yes, unfortunately it is. It is going to be based on what other income's coming into the house.
My understanding is that that's been relaxed a little bit though, that the income testing and asset testing has been expanded to So previously,
it was quite restrictive. So definitely, it is going to be assessed on. It is based on
family income.
Yep, other income that's being received in the family. But it's just a matter of obviously speaking to Centrelink and making sure that if the rates have been relaxed a bit, to make sure that you're still eligible.
Yeah, I'm pretty sure we've had a few clients be able to apply for job seeker even though their partner's still working, because I believe that the family income threshold has increased substantially. So definitely put your application in with Centrelink to try and get that approved for yourself. So we've talked about employees or individuals that have lost their job completely and they're either receiving job seeker or job keeper. What I'd like to move our attention to now is employees who are still employed but they're doing reduced hours and their income has reduced. And we're seeing a lot of this. This is probably the most common thing, I think.
This is the most common. And it's interesting because some employers are asking, obviously, for people to take their annual leave because their amount of hours that they are required to work has reduced somewhat. And it's just about, obviously, communicating. There has been some legislation in regards to basically, as an employee, you're not allowed to refuse to take your annual leave if your balance is up to 2 weeks or more. You're not allowed to. You don't have to take your annual leave if it's less than 2 weeks balance. But they are. There has been guidance as far as the ATO is concerned to not outright say no to your employer if that is the situation that they've given you. So it's just about compromising. We all want to work as a team. We all want to obviously get paid, but it's just about understanding where everyone is at financially. And keeping the relationship and communication open with your employer is a good idea.
And one of the ideas that I had, so I'd love to hear your thoughts on this, is if you do have reduced income, once again, it might mean that you've overpaid tax for the full financial year. So you can lodge a variation to withholding tax form to try and get your remaining tax reduced. Do you think that's a strategy that could work so that you don't have to wait until you lodge a tax return to get that tax refund?
Yeah, the situation, you can definitely look to complete a variation form, withholding variation form. It will be up to scrutiny with the ATO, so it may be, by the time they actually process it, it'll be July anyway, so it may not be up to a possibility to do it, and it might not be immediate, I guess, in regards to getting that cash flow coming in, but definitely a good idea. I will say the ones that, the individuals that have paid tax in the past because they've received trust distributions or rental property income or dividend income, and their situation's changed, they may want to look to vary their PAYG instalment just so they're not paying the tax if they don't need to, just so that gives them a little bit of leeway as far as cash is concerned.
And what happens with individuals that take money out of their super during this period? So one of the relief packages for individuals that have been affected by Covid-19 is that they are able to take out up to $20,000 from their superannuation fund to actually help with cash flow, which we will be running a Facebook Live session next Monday about whether that is a good idea and talking about shares and super in this time. So please don't do anything until you've watched that segment. But if people have chosen to do that or are thinking about that, what are the finance and tax implications of that?
So basically, with the superannuation, basically cash incentive, you do still have to be eligible for it. So you either have to be made redundant, you have to either have your work hours reduced by 20% for what you're normally receiving, and basically if you apply through your MyGov account, they've suggested, but you will, if you do receive the $10,000 superannuation injection, it is tax-free.
So it's tax-free, so you don't have to pay any tax on that.
On it,
so you can just get that straight into your bank account, no tax. And okay, so there's really no tax implications.
No tax implications
as far as that's concerned.
It's just about providing you with additional cash, I guess, in this period of time. And so you obviously can apply for that before the 30th of June, and then apply on the 1st of July if you wanted to
for
get
another
that again.
Once again, I stress that you just wait until you watch our segment next Monday.
I agree.
Because there's a lot of complications of taking money out of super, particularly at a time when superannuation has dropped so low.
Exactly. Yeah.
So you're taking out a lot more than you think you're taking out. So yeah, definitely keep that in mind. We've had a question come through from Sue in relation to the state government's announcement about the land tax relief for property investors.
Yes.
So land tax was obviously a very contentious issue that came through. And Sue just wanted to ask about the land tax relief that's being offered for property investors. So let's talk a little bit about that. That's a state government initiative.
State government again, and it's through Revenue SA again. They are pretty much, again, Revenue SA has been really good on forefront to say don't apply, you don't need to apply. They will automatically do it for you. So it's basically deferring your 2 quarters worth of land tax.
So does that mean that they won't send out the bills?
No. Well, I don't know if they're going to send out the bills or not, but there's no payment requirement.
Okay, or maybe they'll just send out the bill and defer the payment due date.
Yeah, so basically they've just turned around and said, don't do anything, we'll be doing it for you. So they may turn around and send the bills out, but just maybe put on there's no payment required. But that's a good kind of something that you don't have to worry about as a property owner.
So just to be clear, it's not a land tax reduction, it's a land tax deferral.
Yeah.
Okay, and there is some news around the relief package. So there was a relief where for individuals that had an increase in land tax, they were going to be able to access a 50% relief of the increase.
Yeah, that's right.
And let's talk about that because that's now been increased to 100%, I believe.
Yeah, so if you are eligible for it, obviously there's a criteria again for that one, but if you are eligible for the land tax relief regime, the tax bill has to be increased by $2,500, I believe, and if you are in that criteria, then that will also be deferred.
Just as a simple example to throw out there, for an individual whose land tax bill was going to increase by $10,000, they might have been eligible for a $5,000 relief under the current rules, but now with coronavirus, they might be eligible for a full $10,000 relief, which means that theoretically they should be paying the same amount of land tax this year that they paid last year.
Yeah, that's correct.
Is that right?
Yeah.
So hopefully that answers that question.
Yeah.
Is there any other tax tips that you think individuals need to be aware of, or anything else that they should do to plan for tax time? And we obviously have a lot of viewers that are actually still employed in their full-time capacity as well, so we can broaden the question up to include anyone that needs to have some tips preparing for tax time.
Yeah, so I guess the other thing that we were going to have a quick chat on is the tax office's home office deductions that they've put in.
That's a good one.
So this is an interesting one. The ATO have done a predetermined flat rate of 80 cents in the hour, which doesn't really account to much, but it is just a flat rate that makes it easier for individuals to be able to say, okay, well, this is how much I'm going to be claiming.
So does that mean that every individual that's currently working from home can claim 80 cents per hour of time worked at home as a deduction in their tax return?
Yeah, that's correct.
Does that impact their capital gains tax? Does that impact their ability to sell their home capital gains tax free or anything like that?
Not at all. It's all relating to the running of the property or the running of the home office, I guess, in that respects. So you're looking at basically the cost of the light and power, sitting in front of your desk, taking phone calls. They're allowing you to have a flat rate of 80 cents in the hour. They do actually ask you to document in a diary or calendar the number of hours that you're going to be working from home or have worked from home, so that you have that substantiated evidence.
So is that an ongoing thing, or is that just a special thing with coronavirus?
That one's a special thing with coronavirus, the 80 cents flat rate.
So when does that start? So is it as of the 1st of March? Or
yeah, I believe it was from the 12th of March, but it could have been from the 1st of March. Yeah.
So for people that were working from home prior to that, are they able to claim hours for working from home prior, or how does it work?
Yeah, so the catch-22, I guess, with this is if you are claiming the flat rate, you can't claim anything else relating to the home office expenses. So in the past, some individuals may have claimed a square meterage basis or a number of main rooms and claimed 1/5, for example, of the home office. So we need to kind of look at what you've claimed in the past and what you want to claim in the future, because you can't claim both. And if you do claim the flat rate, you can't claim depreciation on printing materials, or you can't claim stationery that you purchased, you have to claim for the flat rate. So it's about matter of obviously doing your calculations to see if it's better for you to claim the way you have done in the past, and get the higher deduction as far as what's going on in this situation.
So it just depends on your situation as to what's best to claim. So that's also a good thing to refer to the accountant just to... I'm going to put you on the spot. Are you happy to take phone calls from any of our viewers following this today? Just to, with any questions that they have. So Amanda, you've heard it here. It's recorded on video. Amanda is happy to answer any questions post this session today, and she's a wealth of knowledge and really helpful. So I think that's been really good. Shout out to Steliana and Giselle. Thanks for joining us, ladies. So is there anything else that you think we've covered quite a bit, and we're nearly out of time, but I just wanted to open it up to see if we've got any last minute questions or anything else that you think our viewers should be aware of?
Yeah, I mean, just bear in mind, obviously it's becoming the end of the financial years. We've got like two months to go. So look at your circumstances, look at your taxable income, see how your situation has changed based on what's going on currently in the economy, and for yourself personally. If you can look to maximise your deductions, perhaps look to super, putting some additional contributions there. But basically just keep a review. I would review on what your situation is at the moment, and see what's you can do in the next 2 months to kind of maximise your tax return at the end of the year.
That's great. Thank you so much for your time, Amanda. It's been wonderful, and hopefully it's been useful to you guys today. Now, of course, we are here to help you. We're here to support you through this. So any questions that you have, come through to your Rise High Mortgage broker. Speak to Amanda. We'll put her details in the comment section below after this video. And we have put in a few links as well that can give you some more information. So hopefully that helps you. We've also got an excellent blog on the Rise High Financial Solutions website. So if you go to risehigh.com.au, in the blog section, you will see our blog called You're Not Alone, Covid-19. That's an excellent blog that has links to many education videos that we've posted, and links to many education pages that we've linked to give you all the information that you need about everything you need to know during this time. So we are here for you. We've got your back. We're here to support you. Please reach out if you need help. And thank you once again to Amanda. You've been wonderful, and you've answered lots of great questions. So thanks, guys. We'll see you again on Monday, where I will be meeting with Chris Harris from Excel Super, and we're going to be talking everything shares and superannuation during coronavirus. So that's 1 o'clock next Monday. We'll see you then. Bye.
See ya.